In this video, we're going to have a look at Visa, and contrary to my previous videos, which are very long format, I'm going to try and go through this data rather quickly here. So of course Visa is the biggest payment provider in the world. Whenever you make a purchase with your Visa credit card, they get a share of that purchase. So therefore Visa is a very stable company and it kind of grows in line with consumer spending. So looking at the revenue here, we can see that overall they've been growing it at 9.5% and they've been growing their earnings at 7%. They are growing steadily and consistently. Their revenue and earnings barely ever go down, and overall that's just a very growing trend. They didn't really have any debt up until 2016, where we started to include some leases as well. So the big increase that we see here is mostly because of the short-term liabilities, not so much long-term. They don't really have much long-term debt. They are relatively debt-free here, which is also what we see in the ratios later down the line. They also have quite some cash on hand. Now of course they can use this cash to just pay down their debt, but they can also use it for acquisitions or to buy back shares or pay out a dividend. Nevertheless, it's always nice when a company has some additional funds on their balance sheet to really cushion any headwind that may be coming. Market cap has been increasing by 12% every single year, even though their share count has been decreasing. So this is very nice to see and quite attractive as an investor. Enterprise value is the entire value of the business. So we take the market cap to which we add the debt and we subtract the cash and we get the complete value of the business. And this has been growing in line here with market cap because of course Visa does not really have much debt on their balance sheet. Ebitda, the ratio with which Visa has been trading for the past 10 years is relatively high, always double digits, a low point here of 13.5 and a high point of about 34 times. Now of course they are growing very steadily, they are growing in line with the economy and they have amazing margins, as we'll see in their cash flow statement later down the line. So I think it's completely fair for Visa as well as their competitor MasterCard, whom we'll have a look at later, to trade at a premium of double-digit multiples because they have been growing consistently, they have no debt, they have a very secure business because people always need to purchase things and need a provider to handle that purchase for them. So I think Visa is in a very steady spot here in the future as well. Net debt to EBITDA, they basically have no debt on the balance sheet like mentioned, so there's no risk of bankruptcy here whatsoever. Looking at their cash flow, we can see that their cash flow from operations, all the money that they make simply from running their business, has been growing like crazy. 20% here for the past 10 years, every single year. At the same time, their capital expenditures, all the future investment that they have to make to keep on operating their business, is very, very low. It's grown from 470 million all the way to about 1 billion, but compared to their cash flow from operations, it's basically nothing. 1/18 of their cash flow is being used for capital expenditure. So the margins on Visa are absolutely insane. They make a lot of money. They are a cash flow machine, and this is of course why many investors are interested in a company like Visa, as we have also seen with big investors like Warren Buffett, who is very interested in Visa and MasterCard and payment providers. So this then brings me to the free cash flow, which is the cash flow from operation minus the capital expenditure. Now because there's barely any capital expenditure, of course the free cash flow is very, very high. And what exactly do they do with that free cash flow? Well, if we look at the next column, we see they are consistently buying back shares. They have reduced their total share count by about 500 million here in the past 10 years. They've reduced it by 2% every single year, which has greatly rewarded investors for the past decade. Now they also pay a steadily growing dividend with their free cash flow as well. So overall they are mostly using their cash to directly reward shareholders, which is very, very nice to see as an investor. The free cash flow per share has increased from about 90 cents all the way to $7.50, 24% annually. Now, of course, this number is influenced by the fact that the first year, 2013, is very, very low compared to the overall trend that we see here. So if we try to normalize this a bit more, we see a average free cash flow per share of more around the 10 to maybe 15%. Price per share has increased by 14% every single year, a high point of about 224, which is also the price it's trading at right now. The free cash flow yield of Visa has on average been around 3%. Now for the past year here, 2022, at a price of $180 a share, it was 4.2%, which I think is quite a high number compared to their historic average here. So I think Visa was definitely underpriced here at $180 in 2022, which we can also see for the enterprise value here 22 times, while historically it's been 20, and for the 4 or 5 years before that it's definitely higher than 24 times. So 2022 I think was a very attractive year to buy Visa. Now we might be a little bit late to the party, but there might still be some interesting returns here. So let's try to forecast Visa into the future. Looking at their historic Ebitda growth, we can see about 7% every single year. For 2013, because there are fears of a recession and the purchasing power is decreasing, I expect them to grow a little bit less because they mostly grow in line with the economy. Because I don't expect the economy to grow too much in 2013, I'm going to give them a 5% Ebitda growth here. And then I'm going to pick it back up from 7% for the 4 years after that, and then I'm going to give them 6% for the final 5 years here. I'm also going to attach a multiple of 26 times, which is slightly higher than the historic multiple, but definitely I think the multiple that they've been trading at for the past 5-6 years. Of course, you have to realize they are a very steady company, they are steadily growing, they have basically no debt, and they are growing in line with the economy, and will probably be relevant long into the future as well, unless of course the crypto revolution is going to its next chapter, but I don't expect that to happen anytime soon. I think Visa will have a very secure spot here in the future. This gives me an enterprise value of about 940 billion, to which we subtract the debt, we add the cash, gives me a market cap of 940 billion. Divided by the amount of shares outstanding, and I'm assuming here that the amount of shares outstanding remain the same. I am not reducing this because that requires free cash flow, which I cannot really use in this model. So I'm assuming for it to remain the same. If it does go down, of course, it's only in the benefit for us as an investor. I'm lowballing the price here. So this gives me a stock price 10 years from now of about $393.94. So let's have a look at the free cash flow model. I'm going to grow the free cash flow by 8% here for 2023. Now you might be wondering, historically they've been growing at 24%, which is true, but I think the moment that you try to normalize this number a bit more, you do see a more gradual trend of about 10 to 15%. And because the economy, I think, is going to, well, not shrink, but not grow as fast in 2013, I'm starting with an 8% growth. Then I'm going to take that average growth of about 12% for the 4 years after that, and I'm going to reduce it by 10% for the final 5 years. I'm also going to attach a 3% yield, which is kind of in line with what they've been doing historically, maybe a little bit lower. But then again, I do think here for the past 6-ish years, 3% seems to be around the norm, maybe even a bit higher than the norm. So I think 3% is a perfectly accurate number. This gives me a stock price 10 years from now of $682.18. Looking at both our projections, I get an average share price 10 years from now of $538.06. Right now on the open market, you can buy as many shares as you want for $221.04. Simply looking at the price on the stock market itself, this gives me a return of about 9% every single year. But of course, the moment that we include the free cash flow that we know that we will be receiving here in the future, I expect an IRR of about 15.1%. And this basically implies that we use all the free cash flow that we have projected here and divvy it out directly to investors. Now, of course, if they decide to buy back more shares, which I'm sure they will, we can expect our enterprise value multiple to increase as well. So the returns may be a bit higher than 15.1%. On average, I always say the stock market returns about 10%. So I think compared to the overall stock market, Visa is definitely outperforming it by a little bit. Not by much, but by a little bit. But I think given the consistency that Visa provides and the rewards for shareholders in the form of stock buybacks as well as dividends, I think Visa is a very stable company to have in your portfolio here for the future. I will definitely be adding Visa into my portfolio, because even at $221, I do think that Visa is an attractive buy for the long term. But let's see what happens if the price goes up or comes down a little bit. So the moment that the price goes down by even 10%, I expect an IRR of about 17%. If it goes all the way back to 176, which it has been in 2022, as we can see here, their stock price actually reached this point already, then I expect an IRR of about 19%. And I think 19% with a relatively conservative estimate, with a consistently growing company like Visa, is very attractive. So overall, I am quite optimistic about Visa. Thank you very much for watching. Don't forget to like, subscribe and all that good stuff. And please let me know whether or not you like this little bit shorter format or the longer one. Until next time, cheerio!